Let me ask you a question. You've saved for years, contributed to your RSP, maybe even maxed out your TFSA. Now you're getting ready to retire. But here's what no one tells you. If you withdraw your retirement income in the wrong order, you could end up paying tens of thousands more in taxes over your lifetime, not to mention losing out on benefits like OAS or triggering tax brackets you didn't even know existed. Most Canadians focus so much on saving for retirement, they forget about planning how to withdraw it. And that's where the real tax mistakes happen. Today, I'm going to walk you through how to build a tax-efficient income plan in retirement so you can keep more of what you're worked so hard to save. Hi, if you're new here, my name is George McConaughey, and I'm a portfolio manager at Novus Pro of Raymond James. I help Canadians make informed financial decisions, structure tax-efficient retirement income strategies, and navigate the transition from earning a paycheck to paying themselves for life. Let's get into it. Step 1, your income in retirement will come from multiple buckets. When you're working, your income is simple. You earn a paycheck, taxes are withheld at the source, and you use what's left for your day-to-day life. Well, once you retire, that structure disappears. You're now responsible for generating your own income from multiple sources, each with its own set of tax rules and planning consideration. Think of these as your retirement income buckets, one of my favorite words. Most Canadians will draw retirement income from a combination of CPP, that's in Canada, a monthly government benefit based on your contributions during your working years. OAS, Old Age Security, a federal benefit that begins at age 65 regardless of work history. You can delay that. Subject to clawback if income is too high. RRSPs or RRIFs, registered savings that were tax deferred during your career and now are fully taxable when withdrawn. TFSAs, tax-free savings accounts where growth and withdrawals are completely tax-free. Think of it as your own pension plan. Employer pensions, such as defined benefit or defined contribution plans. Non-registered investments, accounts such as individual, joint, or trust accounts, which generate taxable income. Corporate accounts, if you're a business owner and have retained earnings within your company, each one of these income streams is taxed differently. RRIF withdrawals and CPP are fully taxable. TFSA withdrawals are tax-free. Non-registered investments may trigger capital gains, interest, or dividends, all taxed differently. Corporate dividends may allow for income splitting or other tax strategies, depending on your structure. This is where retirement planning starts to become more complex. The question is no longer just how much money do I have, but where is it held? How is it taxed? And when should I access it? If you're not careful, the order you draw from each bucket could push you into a higher tax bracket, trigger the old OAS clawback, cause you to lose access to tax credits or benefits, reduce the longevity of your savings over time. On the other hand, with proper coordination, you can, 1, minimize taxes over the life of your retirement, create a consistent, predictable cash flow, keep your government benefits intact, extend the life of your portfolio by using the right buckets at the right time. In the next step, we'll start with the account most people default to, but often misuse, the RRSP. Step 2, don't wait too long to touch your RRSP. One of the most common assumptions I see with new clients is this: just going to leave my RRSP alone for as long as possible. On the surface, that sounds like a smart move. After all, RRSP withdrawals are fully taxable, so why not defer them and let the account keep growing tax shelter? But here's the problem: this strategy often backfires. Let's walk through why RRSPs can become a tax time bomb. An RRSP is great for building wealth during your working years because it gives you a tax deduction when you contribute, tax sheltered growth while the money stays in the account. But it's important to remember, you're only deferring taxes, not avoiding them. Eventually, the government wants its share, and that moment arrives when you begin withdrawing funds, either voluntary or you're forced to convert your RRSP to a RRIF by the end of the year you turn 71. You start taking mandatory withdrawals at age 72. These RRIF withdrawals are based on a government prescribed percentage of your account balance and that percentage increases as you age. So what happens if you delay the withdrawals until 72? You've accumulated years of growth. Your account balance is now much higher. Your mandatory withdrawals are now larger, and your tax bill is much bigger. Even worse, if your taxable income becomes too high, you could lose part or all of your OAS through the clawbacks. That's why in many cases, it actually makes more sense to begin withdrawing from your RSP earlier, often in your early to mid 60s or even as early as retirement, depending on your situation. How early? RSP withdrawals can help you. Starting to draw from your RSPs before 71 can help you lower your RSP balance gradually over time, reduce future RRIF payments, withdrawals, and tax exposure. Avoid triggering the OAS clawback later. Fill in income gaps before CPP and OAS begin. Take advantage of lower tax brackets early in retirement. This is especially useful during what we call the low income gap year, the window between when you stop working and when government benefits or pensions begin. For example, you retire at 60, you delay CPP and OAS until 67 or later. Between 60 and 67, your only income is what you choose to draw. That gives you full control over your tax bracket during this window. This is often the perfect time to withdraw modest amounts from your RSP while staying in a lower tax bracket and by gradually reducing your RSP balance during this period. You're not only smoothing your income, you're reducing the chance of tax shock in your 70s and 80s. Waiting until the last possible moment to access your RSP might feel like the most conservative move, but in many cases, it can actually result in more taxes, less flexibility, and fewer benefits down the road. A well-planned, gradual withdrawal strategy built around your full financial picture can give you more control over your income, lower overall taxes across retirement, a smoother drawdown of your asset. In the next section, we'll look at your TFSA and how to use it to complement your RSP withdrawals and manage your taxable income year by year. Step 3, use your TFSA strategically. When people think about the TFSA, they often think savings and immediately associate it with something low risk like a high interest savings account. But the TFSA is so much more than that. It's one of the most powerful tax planning tools available to Canadians, especially in retirement. Why the TFSA is so valuable, unlike an RSP or RRIF. Money inside a TFSA grows tax-free, can be withdrawn at any time for any reason, tax-free, does not affect your eligibility for income-tested government benefits like GIS or OAS. Reopens contribution room the following year for any withdrawals you make today. That flexibility makes it extremely valuable when building a tax-efficient retirement income strategy. How to use your TFSA for retirement income planning. Most people are focused on putting money into their TFSA, but once you're retired, the key is to start thinking about how and when to pull money out strategically. Let's look at a few ways your TFSA can complement your other income sources. Number 1, supplement RSP RRIF withdrawals. Let's say you're planning to withdraw $40,000 from your RRIF this year, but doing so would push you in to a higher tax bracket or trigger a partial OAS clawback. Instead, you could take $30,000 from your RRIF and top up the rest with a $10,000 TFSA withdrawal. Now you've got the cash you need, but you avoided pushing your taxable income any higher. Number 2, cover one-time or irregular expenses, whether it's a home renovation, a family vacation, or an unexpected medical cost. Pulling that amount from your RSP or RRIF could spike your taxable income. A TFSA gives you a tax-free way to cover those larger expenses without throwing off your overall tax plan. Number 3, fill income gaps before CPP and OAS kick in. If you retire early and choose to delay CPP and OAS until age 67 or max 70, your TFSA can act as a bridge to help you maintain your lifestyle without triggering high taxes. Invest for growth, not just savings. TFSAs are not limited to savings accounts. You can hold stocks, bonds, ETFs, GICs, mutual funds, because all the growth is tax-free. Your TFSA is an ideal place for investments with long-term upside. Just make sure the risk level matches your retirement goals. If you're only using your TFSA for savings, you're leaving value on the table. Use strategically your TFSA as a tax-free, flexible income tool that plays a critical role in reducing your overall tax bill and extending the life of your portfolio. Now, let's talk about two government benefits that get a lot of attention: CPP and OAS, and how timing them properly can give you even more flexibility. Step 4, know when to start CPP and OAS. One of the biggest retirement decisions you'll make is when to begin your government benefits. And it's not just about when do I need the money. It's also about how your timing impacts taxes, income, and your overall retirement strategy. Let's break it down. Understanding CPP. CPP is based on how much you earned and contributed during your working years. You can start taking it as early as age 60 or delay it until age 70. Every month you delay past age 65, your benefit increases by 0.7%. That's an 8.4% per year, up to 42% increase if you wait until 70. Sounds great, right? Yes, but it depends on your full financial picture. When it might make sense to take CPP early, you need the income to cover expenses, you have health concerns, or a shorter life expectancy. You're drawing less from your RSP now and want to supplement income early. You want to reduce pressure on your savings in your early 60s. When it might make sense to delay CPP, you're healthy, you're expected to live well into your 80s and 90s. You can support your lifestyle from other sources like RRSPs, RRSP withdrawals, or your TFSA. You want higher guaranteed income later in life. You're trying to reduce future taxable withdrawals from your RRIF. Delaying CPP creates a larger income floor later in retirement when your portfolio may be more vulnerable to market risk or longevity risk. What about OAS? OAS is a non-contributory benefit. Most Canadians become eligible at age 65. Like CPP, you can delay it up to age 70 and receive a 36% increase in monthly payments. But there's a twist. OAS is subject to a clawback if your income exceeds a certain threshold. As of 2024, OAS clawback threshold starts at around $90,000 and you're fully clawed back around $148,000 per year. How OAS timing fits into the plan? If your income in retirement is moderate, taking OAS at 65 is often just fine. If you have higher income or significant non-registered investment income, delaying OAS could help you avoid or reduce the clawback. Like CPP, delaying it increases your future income, which can reduce the pressure on your investments later in life. These aren't just government benefits, they're critical levers in your retirement income plan. Coordinating when you take CPP and OAS with when you draw from your RSP or TFSA can flatten your tax bill, smooth your cash flow, and help you get more out of the savings you worked so hard to build. In the next step, we'll explore another powerful tool, income splitting, and how it can save thousands in taxes or time if used correctly. Step 5, split income with your spouse. If you're married or in a common law relationship, one of the most underutilized tools in retirement tax planning is income splitting. Here's how it works. The Canadian tax system is progressive, meaning the more income you earn, the higher the percentage of tax you pay. So if one spouse earns significantly more than the other in retirement, your household could be paying more tax than necessary. That's where income splitting comes in. The government allows couples to shift up to 50% of eligible retirement income from the higher income spouse to the lower income spouse. This helps balance out the taxable income between both partners, often resulting in a lower total tax bill. Eligible income for splitting, age 65 or over, with withdrawals, annuity payments from registered funds, defined benefit pension payments, certain other qualifying pension income. Note, RSP withdrawals do not qualify unless converted to a RRIF first. Why income splitting matters? Let's say your spouse has very little income and you're drawing $60,000 per year from your RRIF. If you don't split that income, you'll be taxed on the full $60,000. But if you split it 50-50, you'll each claim $30,000 of income. You both fall into a lower tax bracket. You may also both qualify for the $2,000 pension income tax credit, doubling your tax savings over time. Income splitting can save a household several $1,000s per year in taxes, especially once both partners are over 65. It's simple to set up and happens when you file your tax return using Form T-1032. No need to move money between accounts. It's just a tax election, so don't leave that money on the table. A proper retirement income plan should always evaluate how to use income splitting to reduce your household tax burden. Step 6. Keep an eye on the OAS clawback. It is a government benefit available to most Canadians. Starting at age 65 in 2024, the maximum monthly OAS benefit is around $713, or roughly $85.56 per year. But here's the catch. OAS is income tested. Once your net income reaches a certain threshold, about $90,000, the government begins to claw back those dollars of your benefit at a rate of 15 cents per dollar over that threshold. By the time your income reaches roughly $148,000, you lose the entire OAS benefit for that year. This is what is known as OAS clawback zone. Why it matters: many high-income retirees get caught off guard. They didn't plan for a spike in income, maybe due to RRIF withdrawals, investment gains, or a property sale, and suddenly their OAS benefit is reduced or eliminated. The frustrating part: often a spike in income was avoidable with better planning. How to avoid or minimize OAS clawback: withdraw from your RRSP gradually before age 71 to avoid large RRIF withdrawals later. Delay OAS if you expect your income to be high between ages 65 and 70. Use your TFSA to supplement income without increasing your taxable income. Split income with your spouse to reduce your reported income. Avoid lump sum withdrawals from RRIFs or non-registered accounts in years when your income is already high. The goal is to manage your income year to year so that you don't accidentally trigger unnecessary benefit losses. If your projected income is within $10,000 of the OAS clawback threshold, you want to be especially careful. It's often possible to make small adjustments that save you thousands, not just in taxes, but in recovered OAS benefits. Step 7. Build a year-by-year withdrawal plan. You wouldn't build a house without a blueprint. The same should go for your retirement. Unfortunately, many Canadians enter retirement without a clear plan for how much to withdraw, when to take it, and from which account. They take money when they need it, reactively without thinking about the tax consequences or how it affects future years. The result: higher than necessary tax bills, missed government benefits, confusion around income sustainability, poor coordination between accounts. A better approach is to create a long-term withdrawal map, a year-by-year projection of what your income will be, what account will it come from, what your taxable income will be, how that impacts your tax bracket, credits, and government benefits. What a proper withdrawal plan looks like: let's say you retire at 60 and plan to live to 90. A 30-year plan would include RRSP drawdowns in your 60s to smooth out future tax brackets, delayed CPP and OAS to increase future guaranteed income, TFSA withdrawals to supplement or replace taxable income, RRIF conversion timing, and minimum withdrawal planning, income splitting projections for you and your spouse, taxable investment withdrawals, capital gains planning, lump sum needs like travel, renovations, healthcare. The goal is to flatten the curve. You want your taxable income to remain relatively stable over time, not spike in your 70s and 80s due to forced RRIF withdrawals. When done right, a coordinated income plan can reduce taxes, protect government benefits, and provide a more predictable and stress-free retirement experience. Retirement income planning isn't just about numbers. It's about strategy. Saving for retirement is only half the journey. The second half, withdrawing your income in the right way, is where many Canadians unknowingly lose ground. The tax system rewards those who plan ahead. It gives you the tools: RRSPs, TFSAs, CPP, OAS, pension income splitting, corporate structures, the ability to defer or accelerate income. But without a strategy that brings all these tools together, it's easy to end up paying more tax than necessary and losing access to benefits you've already earned. So what's the solution?
You need a plan, one that accounts for all your income sources, your timing for withdrawals, your expected expenses, your tax exposure year by year, your personal values like legacy, charitable giving, or travel. And most importantly, you need to revisit that plan regularly because life, markets, and government rules change. If you want help building a personalized, tax-efficient retirement income plan, I invite you to book a free consultation with me. Click the link in my bio to schedule a time, and let's create a retirement strategy that's built for your life, not someone else's. You book that appointment, make sure you ask me about our tax-free savings account, Snowball, which is incredible during retirement.